To remain updated with the latest business news, click on the bell icon.
And you're watching Ask Udayan, the show where we answer all your questions on stocks. I'm Abha Bakaya. With me, our global business editor, Udayan Mukherjee. A very difficult time indeed if you're an investor to try and assess the right strategy with markets being fairly volatile, a lot of uncertainty with regards to the way things are going to go. And this is really when you need to reconsider how and where you invest in the stock markets. Let's start off with some of those queries. Remember, do keep sending them in to the number on your screen. We'll select a few and answer them on TV and online every Wednesday. Mayang Singh from Kolkata has a question on CAMS. Let's listen in to exactly what his query is.
Hello then, I am Mayang Singh. So I've been holding 20 stocks of CAMS bought at about 3000. It had gone up to 4000 and came down back to 3000 and hovered around 3000 for quite some time. But now it has fallen considerably below 3000. When do you see a reversal happening in the stock, and also are fundamentals all right with CAMS?
Yeah, I think CAMS is a good company. I mean, as you know, since you have been tracking the company, it's India's #1 mutual fund registry and transfer agency, and it's a two-player market. CAMS and KFintech are the two players, and CAMS is by far the dominant player in mutual fund registry and transfer. It's a stable annuity kind of business. I mean, as the mutual fund business grows, as more and more people buy mutual funds in the country, you will keep getting regular income stream for CAMS. So that's a very good a bread and butter business to have. But what's also interesting now is CAMS is getting into the account aggregator business, which means that financial data providers can go through CAMS to provide the data to financial data users. So this bridge between data providers and data users is something which might pay off. I mean, it's a new business for them, but in the days to come, in the years to come, I think it might be an interesting place to get revenues from as well. So overall, it's an interesting business and a good play on capital markets and mutual fund penetration in the country. And it's a duopoly, so I don't think profits is an issue for CAMS going forward. The only issue with all of these companies, mid-cap companies, which are fundamentally good, are that valuations had got terribly extended. So as you said, I mean, it went to 4,000, but now it's come off to about closer to 2,500. Still trading at about 40 PE multiple, so it's not cheap yet. But the good thing about this correction which is unfolding now is that many of these very lofty valuations will skim down to entry points where you can consider owning them. So I think CAMS, to cut a long story short, is a good business and it's a good story to back. And maybe this correction will give you a better price point to average your holding. But I think it has the makings of a long-term proposition.
Okay, Siri Das has also sent in a query from Dubai, and this one is on Yes Bank. Go ahead.
Hello, Mr. Udayan. This is CD Das from Dubai. I have around 2000 shares of Yes Bank. The average buying price is something around rupees 375 per share. Just I wanted to know how long I have to hold these shares, or I should buy more to average out the price, or it is better to get rid of. Thank you.
I'm not terribly gung-ho on Yes Bank. I know that a lot of cleanup has happened on Yes of its balance sheet, and I think they're trying to put the past behind them, and it's a difficult past. But you've seen what is happening with banking stocks right now. I think they are under considerable pressure, not least because of the kind of very high FII holding that the sector enjoys, and that is working against them at this point in time. But the way the sector has underperformed, I think it's better to look at some of the stronger franchises in the private banking space rather than look at Yes Bank. Particularly so if there is some kind of a COVID wave, fingers crossed on that, and things get sticky on the asset quality front once again, you would not be wanting to hold on to subpar franchises in the banking space. So, I mean, if you had to look, I think you are better off looking at the ICICIs and Axis of the world rather than looking at something like a Yes Bank. It is not as bad a proposition as it was 6 or 9 months ago. I'll grant you that. But I still think there are difficulties along the way.
Rakesh Sachdeva also sending in a query from Kanpur, and this time it's on one of those tech stocks.
Hi, Udayan. Nice to see you. Well, then I am holding some technology stack like TCS, Infosys, Tech Mahindra, L&T Infotech, and L&T Technology Services. And I am holding these shares for the many years. And after this recent surge in the stock market, the total weightage of my technology shares holding has become almost 20%, 25% of my total portfolio. I want to ask you a question that should I keep continue my tech holding as technology seems to be a good bet for the next 3 to 5 years at least, or should I switch to a part of it to some other sector like infra, etc. If you suggest switching, please recommend sector of your choice also. Thank you.
No, I don't think there is any pressing need to switch sectors. I understand the anxiety for having such a lot of your weightage in one sector, but I think there are very strong tailwinds in the technology sector now. You've got excellent stocks in your portfolio. I mean, one cannot pick a better technology portfolio than you have picked. And having done that, I think maybe it makes sense to stay put. The only technical risk to technology right now is that FII seem to be in sell mode, and FIIs hold a huge ton of technology stocks. For some reason, if they start to lighten their portfolio, you might see some kind of short-term blip in the stock prices. But I think fundamentals are very strong. I mean, you've seen the recent Accenture results and the upping of their guidance. I mean, they've upped their revenue guidance from between 12 and 15% to up to 19 to 22%. I mean, that's as big a jump in guidance I've seen from them in recent years. So I think this whole cloud migration story is a real one, and there is a lot to go along that. And therefore, I would not ditch high quality technology stocks in a hurry at all. I think you have a very decent portfolio, and it is, as you said, for the long term.
S. Pratima of Bengaluru also has a query on Bharat Forge. Let's listen in.
Hello. Holding Bharat Forge 200 shares, bought at the rate of 748 per share. Need to know its growth, whether to hold or exit.
You know, Bharat Forge is a good company. It has a very good management. The Kalyanis are very good promoters. And it is not a one-trick pony. I mean, everybody thinks of Bharat Forge as a pure auto ancillary play, but they have a fairly significant non-auto business as well, the industrial business, which actually is doing quite well once again. On the commercial vehicles front, which continues to be their bread and butter, I think things are looking up quite considerably, and they have some decent order momentum on the commercial vehicles front. On the non-autos, as I said, they're doing well again. Passenger vehicles is still a little bit of a drag, but they are making some interesting moves on the electric vehicles or electric cars as well. So I think it's a good portfolio for an ancillary business. Next couple of years, if you look at it together, I think they should be clocking on an average about 30% kind of growth, earnings growth, which is not bad at all. Valuations have moderated. The stock is no longer at 900 odd. It's trading, I think, below 700. So it's no longer a very expensive stock. It's trading at 22, 23p multiple. I would even go to the extent of saying that Bharat Forge probably is better than most of the auto stocks that you can own at this point in time, given the kind of growth expectations we can have.
If you like the video, do like, comment, share and subscribe.